So what's going on? This is David W. Williams, also known as Diamond Dave. I'll wait for some people to file in. And what we're talking about is asking me any questions about options contracts. So you can kind of put that in the chat. I'll answer that. But what we're going to go into really quickly as we wait for people to come into a particular setup is we're going to talk about when you're buying an options contract, what you're actually purchasing, right? Because I think there's a lot of misconception about this. And somebody that was a member of my class, of my program last week, made a statement about something, and I kind of realized that I may not be communicating this effectively, right? So when you're buying an options contract, right, you are buying three pieces, right? So let me put this in the chat real quick. When you're buying an options contract, right, so my bad on that for the silence, right? So when you're buying an options contract, you're buying three pieces, right? So what you're primarily buying is you're buying intrinsic value. So what do I mean by intrinsic value? What I'm defining intrinsic value at is that you're buying a contract that is in the money, right, or at the money. That's what I mean by the contract has intrinsic value. Somebody else's definition may differ, but I'm trying to put this in a position where you can kind of understand it from a simple standpoint, and not because you're simple, because I'm trying to communicate this in a simple standpoint. You're also buying volatility or implied volatility, or some people, I think the Greek is sigma. You're also buying theta or time or expiration, right? I don't care about any of the other Greeks. Why? Because those other Greeks are driven or moved by implied volatility. So the reason why when I teach my particular options training program, the only Greek I teach, the only two Greeks I teach is implied volatility and theta. Well, why? Because implied volatility is going to move the rest of the Greeks. So you're looking at delta, you're looking at, some people teach vega, is because it's going to move those, right? Theta is fixed, it's an expiration date. So nothing can affect theta because it's a fixed date, okay? So I don't care about any of the other Greeks, right? Because they're being driven by volatility. So when you understand volatility, right, you understand what's going to drive the rest of them. Miss Green, is that a question or just a statement? I want to make sure I don't miss a question. So you're only buying those three things. So let me give you a setup. Where most people are making a mistake in the options market, right, is they don't know what they're purchasing. They really don't. They think they're purchasing something that they're not. It's an example. You go purchase a Ferrari. What are you purchasing? You might think I'm purchasing a sports car. No, you're purchasing a maintenance plan. Why? Because Ferraris are very unreliable cars. You're paying a lot of money for a very unreliable car. So what you're purchasing is a maintenance plan because you're not going to be able to drive that particular car without doing a lot of maintenance. So you may think I purchased an actual sports car. No, you may think I purchased status. What you really purchase is a very, very expensive maintenance program, right? That's what you purchased, okay? So you got to know what you're purchasing when you're purchasing a contract, and based on what your goals are, right, what type of contract works for you, all right? So what is your goal? And then what type of contract works for you? And what should be the fundamental thing you're trying to do is minimize the risk associated with your activity. So this is where a lot of people go wrong. So it's interesting how people will consume hours of content about the options market on YouTube. They will buy these courses. And when you ask them, these kind of questions, they can't answer it. Because like a lot of people, they understand technical stuff, but they don't understand principles, right? That's the issue. They understand technical stuff, but they don't understand principles. And that's the problem with the world. Most people don't understand things from a principle standpoint. The real power is understanding principles, not in understanding technical things. Nothing against technicians, but we keep this word tech, doesn't understand principles. Let me give you an example. You can operate a plane now through use of computers and a lot of data from the computers, right? So people are flying planes. When you take a commercial flight, a lot of times it's being manually flown on the takeoff. It's being manually flown on the landing, but it's driver assisted, right? Essentially on the landing. You got to kind of follow almost like a flight path, like it's almost like a video game now. But when you get into the sky, the plane's flying on autopilot. They plot that thing in and they keep it moving, right? But to fly a plane, you got to understand the principles of flight. How does a plane fly based on principles? Why? Because if all that fails, you still need to be able to fly that plane. You still need to be able to fly that plane. So there was a scenario where, and it was an Alaskan airline. It was very unfortunate. They lost, I forgot what you call it. It's like part of their tail. So because they lost their ability to move and manipulate their tail, they couldn't slow the plane down long enough to land it. This is something that's been documented on Google. They took that plane out to the ocean on the West Coast, and they tried to fix that problem. They was flying that plane manually because the actual lever wasn't working. The computer assistant lever wasn't working, so they had to fly the plane manually. Over time, they just ran out of gas. The whole plane crashed, pretty much killed everybody on the plane. But they had to understand the principles of flight to be able to do that. They couldn't just depend on, well, we got this data from this computer that's going to tell us how to fly, so we just going to depend on the data. That's what a lot of people are doing inside their brokerage account. They just looking at the numbers inside their brokerage account and their attitude as well. The numbers are going to tell me what to play. You need to understand the principles of what you're doing. So we're going to start and give you the principles. And Miss Bella, me, I hope this is going to be beneficial to you. And if it's not, ask a question, please. Let me give an example. There's two contracts I was looking at this morning. I was looking at GameStop and I was looking at, PTON. I forgot what the name was, Peloton. So I'm looking at GME and I'm looking at PTON. I believe there's going to be downward selling pressure on both those companies in the future, right? I believe GameStop is going to be a lot more drastic. It's going to be a lot more current. I believe with Peloton, it's going to happen a lot more sustained, a lot more long term. So I'm looking at a GameStop contract this morning, right? I'm looking to buy at the money or in the money. I'm looking to buy an expiration date as far out as possible. And I don't want to purchase a lot of volatility, right? Because I understand what I'm doing when I'm purchasing volatility. We're going to go into that. See, these are the common conversations y'all are not getting. And I talked about this in an earlier video. These people feed y'all this stuff. Y'all respond to it. They feed y'all more of it. If somebody's trying to help you get a real understanding of it and you don't respond to it, you get fed more of what you're not allowing you to become successful. So you got to start asking yourself, why am I eating what I say I don't have an appetite for? Well, let's get back to what we're talking about. So I'm looking at the GME contract. What was available to me was a contract for around $1,000, $1,100 at the money. So, it was like 160, 150 at the money or in the money. But the IV was around 100, 120%. But I could only get an expiration date going out maybe 3 weeks. I think it was July 30th, so not even a full 3 weeks. The August the 2nd was around $1,400 to $1,500 at the money or in the money, right? I'm looking at the Peloton, PTON. I can get a at the money, right? With a IV of around, let's say 45%, but I can go out to January of next year, January 2022. Okay? So now I want to ask you a question. Which contract is riskier? Which contract has a higher degree of risk based on what I just told you? Based on the cost is going to be identical. The IV of the GME is around 125%. I got a 3-week expiration date. The second is a Peloton PTON. Same price point to buy at the money, a little bit in the money. The IV is around 40%, right? But the expiration date goes out until January. Both of them are going to be put contracts. Which contract is riskier, right? And so you got to understand what you're actually purchasing, okay? So the reason why, to me, the Peloton contract was more attractive, why? Because I get to buy more time. I get to buy more theta, which is fixed, right? The implied volatility of the GameStop contract, if it's 125 and I buy it today, and we saw this with GameStop, it sold off and it bounced back up. It filled that gap. So when it opened this morning, it gapped down. It came back up to fill the gap, right? And then it started working its way back down, but it really never sold off, right? So if I was about at open and I buy it at 125 volatility, what happens when it goes back up? My volatility starts to soften. So I immediately start to lose premium. And what do I have? I have a 3-week expiration. Not even 3 weeks, because it's July 30th expiration. The 16th is tomorrow, so I really got 15 days. If you look at most of your contracts, you're going to get a massive volatility crush at around the midpoint of your contract. So if you got a 2-week contract, at the midpoint, you're going to get a massive volatility crush because you at the midpoint of your contract. So the GME is riskier, right? That's a riskier contract. But people will buy that not understanding what they're purchasing. And then when it don't go the way they want to go, they don't understand what's going on, but you don't understand what you're purchasing. And this is what I tell people all the time. Stop trying to buy contracts that are expensive because they're short term, right? Or because everybody else is playing that same play. If you know you only got a certain amount of budget, find the tickers where the contracts are less expensive that you can afford so you can kind of learn how to trade. There's a lot of companies out there. So let's take one, Nokia. Nokia got a really small beta, which means that it doesn't really move. It's not very volatile in response to the S&P movement. So in contrast to the S&P 500, it doesn't really move that fast. However, with Nokia contracts, there's really low premiums and there's low volatility. So you can learn this, how to trade, right? Because you have an environment where you don't have to pay a lot of volatility and you can buy a lot of time. So you can learn puts and calls in this particular playground because what? They're not making you purchase a lot of volatility. Until you learn how to trade, purchasing volatility is one of the most dangerous things you can do for your contract. Why do I say that? This is the type of stuff these people are not telling you on these platforms. What you're purchasing is forecasted movement. You're purchasing the forecast of the movement based on that particular time. So what happens if it doesn't move as forecasted? The volatility starts to soften, which means what? You immediately start to lose premium on your contract. So if you buy that 125, that's forecasted movement. It doesn't move the way they forecasted it, right? The premium starts to soften because the volatility starts to go down, and you know what wall that you're going to hit regardless of anything? You're going to hit expiration date. So one of the actual analogies that I use in my course is that when I knew who Kobe Bryant was when he was a kid, right? I knew who he was when he was a youngster, okay? I had no idea that Kobe Bryant was going to die at 41 years old. But you know what? He was going to die at 41 years old. Wasn't no getting around that. Because death is a door everybody got to walk through. You can't walk around it. You got to walk through it. So when I knew who Kobe Bryant was in the late 90s, when he got drafted by the Lakers, when he was 18 years old, I had no idea he was going to pass away. I was going to know who Kobe Bryant was for probably about another 20 years. I had no idea we were going to have about 20 years with Kobe. But the reality was Kobe was going to pass away at 41 years old, right? So, and your expiration date is a hard date. You can't get around it, okay? So what you got to understand is that when you don't get the forecasted movement and that expiration date is coming, what it does is it starts to decrease the premium on your contract because the market makers are saying, you know what? This contract is not as valuable as we thought because we're not getting the forecasted movement that we thought. So what do? We lower the premium because the contract is not as valuable. So Miss Bella says, but in your example with the IV was already low with the Peloton, wouldn't that make the trade riskier in the long run? So Miss Bella, I want to ask you a question. The IV is lower, so there's a lower forecasted movement. But what did I say we're doing? We're buying at the money or in the money. So if I'm buying at the money or in the money with a low volatility and a longer expiration date, what do I have more time? I have more time to get the direction of movement that I'm looking for. As an options trader, buying naked calls and puts, we're looking for direction of movement. And we want direction of movement with volatility. We don't want to purchase volatility. We want the volatility to take place after we purchase the contract. That's our ideal scenario. So let me give you a scenario, and I put this in the course, but people may have missed it. I knew about COVID, and I probably shouldn't have said that because I'm on YouTube. So I knew about the pandemic in January. But I was so busy in business, I didn't pay attention to it. I told a member of my family, watch yourself, because this person, they take a train to a city to go to work. I called them. If y'all ever seen that movie, 12 Monkeys, heck of a movie, right? Really, really good movie. The virus was spread through mass transit, if you watch that movie. So I was hip to that. So I called a member of my family up and I said, yo, watch yourself on these trains. When you take these trains, because I watched that movie 12 Monkeys, and the way they spread that virus all over the world was the man took these vials with the virus in it, and he went to areas of mass transit, and he contaminated the mass transit area. The virus spread all over the world and essentially pretty much destroyed civilization. So I said, watch yourself, because this thing is real. That's when it was still on the other side of the world. But I wasn't really tapped in to the markets. So, but what I did, though, was I bought put contracts on cruise lines, right? When I bought those put contracts on cruise lines, this was before the Caribbean countries was telling the cruise lines, because of our fear of contamination, we're not going to let you port your boats. This was before you had that group of people on that cruise line off of California, and they tested them for the virus, and they didn't release the information because they had the virus. So I already had the put contracts. I had put contracts that I think I bought in early March that expired in July at the money, because I knew that thing was going to sell off. Because what is a cruise? A cruise is an event-based scenario where you put a bunch of people in the same place. They all sit on top of each other. They breathe each other's air. And what we're talking about with the issue with the pandemic was a communicable disease. So because I come out of the medical space, I understand what a communicable disease is. So this is a perfect environment to spread this thing amongst a large amount of people. So I said, well, because we got Caribbean countries already telling these boats that we don't want you docking on our shores because we worried that people on your particular boat are contaminated, this is going to become something that's going to spread across this whole industry. When I bought those contracts, the IV was very low. Why? Because the forward movement or the forecasted movement from the market makers was not that this thing is going to sell off. Over the next few weeks, those things developed, right? So what happened? Those same contracts I bought, even before we had the movement of the sell-off going down, what did they do? They spiked up the volatility. Well, my premiums went up just because the volatility went up. Then as it started to sell off, I started having contracts with high volatility that now became more and more in the money, right? So if you know Mecca, she had her first 1K day off those Carnival Cruise Lines and off those Royal Caribbean Cruise Lines plays we were making, because those things started going like this. Because what happened is the institutions started pulling out of those particular spaces. Once the institutional money was gone, that thing started to fall like a rock. I saw one contract that I bought for $300 that I sold for $600. 3 weeks later, that same contract was worth $3,000, right? 3 weeks later, that same contract was worth $3,000. I bought it for $600. I bought it for $300, sold it for $600. That thing was worth $3,000. If I would have had 10 grand at that time, I probably would have walked away out of that deal with probably about $100,000. You understand me? That's how much volatility spiked those particular premiums up. So it's not that the volatility is low. You want to buy low. This is why I tell people, learn the company, learn the space. Because if you can get in before they start spiking those volatilities up. I understand your split. In the fridge, you use 4 contracts as an example, buying long-term or high volatility. Okay, so Miss Bella, what I want you to do is reach out to me, because I understand what you're saying, so I can kind of break that down, because I understand example of buying long-term or high volatility, so you're not stuck with a low-moving contract. I may have mean volatility, and I would want to review what I said, but what I'm trying to get you to understand is that you want to buy low volatility from an IV standpoint with the anticipation that the volatility is going to go up and it's going to increase the premiums, right? You do want the contract to move, but what I want you to understand is that if you buy volatility and it does not move and you have a short expiration date, it's going to put you in a position where the contract is going to start to erode in value, because as they soften the volatility and you get closer to the expiration date, right, you're going to lose premium on the contract. So you don't want a contract where it trades horizontal, right, with a short expiration date. You do want a contract that moves, but if you buy volatility you need the situation to remain volatile. So you can buy a weekly contract, but the downside of buying a weekly contract is that if it doesn't remain volatile, you still got your expiration date that you're going to bounce into. So I know a guy that all he buys is weeklies. He's a serious weekly contract trader, but he primarily buys everything in or at the money. Because what happens with a lot of people is they will buy weeklies out of the money because that's what they can afford. So they get a weekly, they buy it out of the money. It has high volatility when they buy it. The challenge is if it doesn't remain a highly volatile situation and you have a weekly, so let's say you buy it on Friday, it expires the next Friday. The problem is it's going to soften the volatility because what do we know is going to happen? Well, the contract expires Friday anyway. So you don't want to buy a scenario that it trades flat. But with the Peloton contract, if I buy at the money and it trades flat this month, it doesn't matter because the contract doesn't expire until January. What I don't want to do is have it start going up in the opposite direction. But if it trades neutral, it's not as bad as if it's trading in the opposite direction. But even if it trades in the opposite direction, it's not as bad because I have a January expiration and I bought at the money than if I buy 2 weeks out at the money and it trades horizontal or it trades in the opposite direction. Because then what happens is my volatility starts to reverse. Because it's not volatile in that particular direction, it becomes volatile in the opposite direction. So I hope I was able to give you some understanding on that. When you're buying a contract, you're always purchasing intrinsic value. What I mean by that, in the money or at the money. You're purchasing volatility. There's nothing wrong with purchasing volatility. I purchase volatility all the time. But the problem is it has to remain volatile. So with the GameStop situation, if you buy that volatility on a 3-week contract, you need it to continue to sell off going down. What they're doing with GameStop now is before they dumped GameStop, which is what I thought they was going to do this time. But they didn't do it. Now that I watched GameStop enough, I know exactly what they're doing. I know I watched it for the last 6 months. I know the play now. But it took me watching it for 6 months to learn to play. I know what they're doing now. Every time it gets above a certain price point, they sell it off because they don't want to get margin called. Then once they sell it under that price point, they just slow sell it. So what they're doing with GameStop now is they're slow selling it. What they did before in the early time of the year is they dumped it. So I was looking for them to dump it. If they dump it, you can buy way out of the money. Why? Because they're going to dump it. So you're going to buy it at, it closed at around 160, 150, whatever today. You can buy a $100 strike to expire Friday because we believe that when the market opens tomorrow, it's going to open up at $100, which means your premiums are going to immediately spike up because it's going to gap down. And what we saw GameStop do is last time they sold it off, it gapped down and it didn't cover those gaps until months later. It went from like $400 to $200. It went down to like $45, $50 in like 3 days. And if you look at the chart, you can see that. So that's what I anticipated. So in that scenario, you can purchase volatility because it's going to remain volatile. But if you buy that volatility now and you buy way out of the money and GameStop trades neutral, which means that it's no longer as volatile as what you bought, or it turns in the opposite direction, which means it's no longer as volatile as you thought, you got a hard expiration date, just like you got a hard expiration date in which you're going to leave this planet that you cannot get around. You're going closer to that expiration date, and every day your volatility is getting weaker and weaker because it's no longer volatile in the direction that you need it to be. If you're buying puts, you need it to be volatility going down. If you're buying calls, you need to be volatile going up. You don't want it to trade sideways. That don't help you. But it's not as harmful if you got more expiration. It's really harmful if you have no expiration. So you got to know what situation you're putting yourself into before you get into the situation and understand what do I need to happen for this to work. And it's not about all this information that you're getting from a computer. It's about you understanding the scenario that you're in and what's the best case scenario and then how do you minimize the risk. So buying GME on a short expiration is very risky now. If you have the capital, you buy GME at the money on an expiration date out as far as possible. I did not have the capital when GME went to $340 right before earnings. I knew it was going to sell off. A monthly expiration at that particular strike was like $6,000. But if I had it and I bought it, I could have made like $30,000, right? Because what GME did is it hit 340. They sold it down because they don't want to get margin called at that price point. It went into earnings. They said at earnings they're going to do an at-the-money offer. They didn't even do a guidance on earnings. They just came out with some financial statements, and they essentially closed. The earnings call was over in like 15 minutes. And the next day, it sold all the way down. And it's on. You can see it on the chart. The day after earnings, so it went from 340. It literally lost in like 3 days. It probably lost $140, $150. That kind of volatility makes you a lot of money in this market, right? But they're going to make you pay for it. And the problem with paying for it is very risky, because if you can't buy the expiration, but you pay for the volatility, and the volatility doesn't sustain itself, it doesn't remain volatile, you immediately start losing a lot of premium really fast. Why? Because they forecast the volatility is not, so they're reforecasting. And the way these computers work now with these contracts, they're constantly changing the value of your contract, especially on a fast-moving ticker. So you can buy it at 10 o'clock in the morning, and it doesn't move the way you want to move, and you can lose 50% in 30 minutes, especially if it's a fast-moving ticker. So if you buy at a particular price point and it goes in the opposite direction, you can lose 50% of the contract in 30 minutes. Like, it can move that fast. That's how bad Tesla used to move fast like that. That's why it was such a dangerous play. Tesla used to be a beast. It's not like that anymore because they expanded the float. Tesla used to whipsaw people. A lot of people lost a lot of money on those plays. Made a lot of money, but a lot of people lost a lot of money because it would just whipsaw. And so the volatility would swing so bad that if you was caught on the wrong side of it, it's like being on the wrong side of a really, really big wave. It's just going to smash you. But that's what I want you to understand that you're buying. So anytime you look at a contract, right, you got to know what you're purchasing. If you purchase short term with high volatility, the situation has to remain volatile for you to make money. Now, yes, you do want the share price to move, right? But it has to move in the direction that you need it to. You don't want it to trade horizontal because you don't have the time for it to trade horizontal. If you buy a lot of time, let's say you buy a 2-year contract and you buy it at the money, who cares if it moves sideways for 2 months? You got 2 years on it. So this is what I want you to start understanding is that if you can buy time in this market, it's hard for this market to beat you. But a lot of times we come into the particular space and we try to make money like that. As a result, we put ourselves in high-risk situations. A lot of this is our environment. It's how we've been conditioned. We think this is how things got to be. So we put ourselves in high-risk situations, and what the market does is it just nickels and dimes you to death. Because if you don't have a lot of capital, find the smaller tickers like the Fords, right? Like the Nokias, those kind of contracts where they have decent volatility, but the premiums are like $6, $7. Learn how to get your percentages, then learn how to get your position size, or play the indexes, which are a lot of times relatively inexpensive because of the volume and how they move. Play the indexes, which nobody likes to play. And when I told people to pick 5 companies, I should have said pick 5 tickers because people forget about the indexes. Learn the indexes, and then you can play contracts that are not as expensive because a lot of these individual tickers, the premiums are way too high because they're vanity plays, right? So Urban Homestead is asking me when I say they don't want to be margin called in my GME example. So Urban Homestead, I really appreciate that question. I appreciate you tapping in. I ain't heard from you in a minute. What I mean is that this is my own personal belief, right? When we're looking at GME, it's being shorted, right? The short sellers are not tripping. The narrative is that we're going to get GME margin called by staying in the play. That's the narrative for all these people buying in. Short sellers aren't worried about you staying in the play. They are worried about the number, that actual amount to get over a certain amount. So like, let's say you take on margin as a short seller. You short sell company XYZ. As long as that share price stays under a certain amount, it's unlikely your brokerage is going to margin call you and tell you, either you got to get out of your position, you got to give us some more money to sustain your margin, right? Or, you got to sell some shares. You got to do something to fix this because your risk is too high. because the brokerage has a really rigorous risk management board. And so they don't want to get you in a bad position with their money, because at the end of the day, you're short selling with their money, right? So they got to make sure that you're not in such a bad position to where you're going to get wiped out and that's going to fall back on them. So my theory is that as long as GameStop stays under a certain number, they're not worried about being margin called, because then the play doesn't become so dangerous that they get margin called. So once GameStop runs up over a certain number, they sell it right back down. And so if you look at GameStop on the yearly chart, after it gets over a certain number, they dump it real hard. I mean, that thing gets dumped with a lot of velocity. They did the same thing right before earnings. It hit around 300 something, and they slammed that thing down with a lot of velocity, like literally almost immediately. Then the next day it came out, they slammed it back down again because they don't want to get margin called. But as long as they keep it under that number, they don't have to worry about it, because they're not worrying about the brokerage coming in and telling them, well, you got to do something about your position, right? Because a lot of times your margin position is based on your relationship with your broker, and they can determine the specifics of whether or not they're going to let you stay in that position, or you got to ask for more money, or maybe you got to liquidate. What they're not understanding with margin calls is that if they margin call GameStop, it's going to hurt GameStop because they're just going to sell it, right? They're just going to sell their position in GameStop and get out. It's not to where they're going to have to cover and GameStop's going to run up. They're just going to dump it and then GameStop's going to fall. Yes, sir. What I mean, Urban Homestead, is that selling right below the strike price, that's going to trigger that margin call. And they just keep doing that. Because what these dudes don't understand is that they can sell it, they can short it, cover, and short it again. They act like they can only short it like once a day. No, we can short it, sell it down. If y'all drive it back up, we can cover it, sell it again, short it again, and just keep doing it. That's how they make their money. These are hedge funds. So they making their money going up and they making their money going down. They make money on both sides, which is what I try to teach everybody. Make money on both sides of the market once you understand what the market does. Don't feel you only can make money on one side of the market unless that's what you like to do. I like to make money on puts. They're easy for me, right? I don't really, to me, calls are complicated. But I can tell that company's going to sell off, especially you just find these, especially these Chinese companies, they selling off all the time. Cashmatic asks, what's a good time? 6 months. Cashmatic, based on your trading plan, based on your objective as a trader, you got to come out with a time span that works for you. But I would always tell you, buy as much time as possible, right? Buy as much time as possible, right? The one thing that we all trying to get in this world, we wish we got is more time. Buy as much time as you can. And if you can't buy enough time to manage the risk associated with the play, that's not the play for you. That's my own counsel. That's not investment advice. I'm not a fiduciary. I'm not a financial advisor, right? I don't have a Series 7. But a lot of times what we do is we take on risk because we can't buy time. And all we do is give money to the market because we're trying to get money fast. I understand it. We're trying to get paid. I get it. But if we sometimes take our time with stuff, it can happen a lot easier for us. Everybody that plays baseball knows that a good pitch, you ain't got to force it. They're going to give it to you. You just got to know how to hit it when they give it to you. So everybody that plays baseball know you ain't got to force a good pitch. The pitch coming. You got to know how to take the pitch when it comes to you. Okay? Gregory Shavers asked, do you think Tesla float will ever get small again? So, no. I don't think they're ever going to contract the float of Tesla. In fact, most likely they'll probably only get bigger. Because the reason why they expanded the float is because they wanted to get more people into that particular company. They wanted to kind of increase the capital in that company. And having that small float made Tesla very volatile. And the S&P 500, I don't believe, wanted that volatile of a ticker. Right? A lot of the companies in the S&P 500, especially a lot of leading companies, they got floats on almost $1 billion, almost 1 billion shares, if not greater. So there's, of course, give outlines for a suitable Power 5. What I tell you to do for your Power 5 is, 1, buy something that you can afford. Buy a company that you don't mind researching, because it's your job to become an expert on that. So get something that you can afford, which is what most people don't do. They're trading tickets that are too expensive for them based on where they're at as a trader right now. They're trading above their head, and they're just giving a lot of money to the market. And I get it because I've done it before. It took me a long time to bring myself down, right? I started low, went up high, had to bring myself back down again. Well, Fallout, the reason why you can't, what's your open interest before you buy the play? So if you understand the concept of open interest and a market for the contract, you can always find a buyer because the market maker, right, is the buyer or seller of last resort. So you can always find a buyer. The problem you talked about is whether or not that particular options chain is going to be liquid enough to get you the ask that you want. But they'll buy the contract. So if you are asking for 100 and you can't find a buyer, cut it to $50. If the contract is positive, it's in the green, you'll find somebody. Miss Bella Me says that there's certain percentages we should be looking for, low versus high volatility. Okay, so to me, this is me personally. I think high volatility is anything over 60 or 70%. But that's based on the expiration date. So there's a difference between high volatility, that's 70%, that expires in 2 weeks, and high volatility, that's 70%, that expires in January 2022. That's not the same thing. So that's why I said the hard date is always going to be that expiration date. And the volatility is forecasted to take place within that expiration date. So you have to watch the ticker to find out what the strike is. May trigger the margin call based on how to watch it. Yeah, but see, Urban Homesteader, that's a scenario with GameStop because it was a highly shorted ticker. Some companies sell off not because they're being shorted really hard. It's because they sell off because people just want to get out of the play. You know, something may happen where it may become too risky. They may have to trim their position. So GameStop is a very specific scenario because those dudes ran into that play because there was a very, very high short percentage that they believed it was. And they were going to, quote unquote, short squeeze it, which is next to impossible to do over a sustained period of time, right? And they felt like that's how they were going to get rich. Without understanding is that these people can sit in these plays for months because they don't have anywhere to go, right? And a lot of the people that are trying to do this, they have something they have to do with their money. So eventually they're going to run out of time because we talked about in this market, you got to try to buy time. The retail traders are going to run out of time. The hedge funds normally will not. But what we're seeing is that once this particular ticker gets over a certain point, it's being sold back down really, really, really hard. And if you can't buy it back up, then you just got to deal with the fact that it gets pushed down, right? Because you can't create the demand to push it up over that particular price. And what we're seeing with GameStop is really once it gets north of 300, they sell it back down, right? So then you got to try to figure out how to keep it north of 300 long enough to trigger the margin call. But like I said, if you get the margin call, it may not go the way you want to go because they may just sell their position. So if they sell their position, if the people that come to buy their position are lower than the particular price point that you wanted to be at, so let's say they say, hey, we'll sell our GameStop position for $250 just to get out of the play, well, then what's going to happen? The share price is going to go right back down. It's also going to increase the float, right? Because those shares are now going to be available to the market, and then they're going to keep trading it. So this idea of margin calling a company as a way to try to make a lot of money in the market, I'm not saying it can't happen, but it can happen more if me, you, Urban Homesteader, and Miss Bella May had a hedge fund, and we can sit together and agree at the same time on how we're going to play this with our capital, as opposed to all these different people trying to do this community play because you can't never determine what somebody else. It's hard to get 13 people that you don't know to do something, right? It's difficult. So this idea that all these different people are going to do the same thing at the same time because they're going to margin call, it's just, I don't think it's going to work. And it hasn't worked. We've seen GameStop just do this. So over time, they're going to just get washed out. And my personal belief is that they're going to slow sell this thing down. And once they get under $100, they're going to force these guys out. They get GameStop under 100, they're going to shake these dudes out of that play. That's my personal belief, right? And it may take another 6 months. But these big companies don't have nothing but time. They don't have nowhere they got to go because they got other plays they working. Right? For a lot of these guys, GameStop they put all their money into GameStop. These hedge funds got multiple plays they working. So they could just essentially tell a computer, just keep trading GameStop like this based on conditions, and then let us know if something comes up, and then we'll deal with it then, and they go worry about something else because they have that type of apparatus built. We got any more questions? But that's what I want people to understand about volatility, time, and intrinsic value. one of our biggest challenges is we're not buying in the money or at the money. We're buying out of the money, right? If you buy out of the money with a high volatility and a short expiration date, that is a high risk play. Don't mean it won't hit. I've hit on plays like that before, right? But just know what you're putting yourself into. So me working with my mindset counselor, one of the things that I'm trying to do as an affirmation is saying to myself that risk management is number one. And so now what I'm really looking to do is to not take on risky plays, right? I'm just trying not to, because I've made a lot of money in risky stuff. But I'm looking to not take on risky plays because a lot of that is a function of my personality that I brought into the market. You know, a lot of people don't really know me. I used to be a big action junkie, right? Because I don't get scared. A lot of people get nervous. I don't get scared. I just don't. To me, high-risk situations, to me, are fun. So the problem is you take that mentality into the market and you can't play with these people like that because they just take all your money from you, right? And I don't have the level of control over the market that I had to manage high-risk situations in the real world. See, so where somebody else will get nervous, I don't get nervous. This stuff don't really bother me. My blood pressure don't go up. My heart, it's just whatever to me, right? So that's my thing. So in the real world, I come out of being an action junkie, somebody that put myself in a lot of high-risk situations because I don't get nervous. I don't get scared. You know, I don't have, those type of issues. You take that into the market, you put yourself in a lot of bad situations that you got to try to work your way out of. And one of the things that I was doing is I was undermining my success to make the situation interesting because then now I got to try to figure out how to work my way out of the situation instead of taking a best case scenario with a high probability that may not be as exciting, right? Exactly, Urban Home said, targeted high risk based on knowledge is the key. Yeah, so you can take a high risk, but you really got to understand what situation you put it on and not take the high risk as a way, well, I'm bored, so let me do something high risk just because I'm bored, as opposed to this is a high risk, but it can also be a high return, and I understand, everything that can come from it. So this is where we start talking about the psychology. This has nothing to do with the market. This is a person's psychology because a lot of people in real life, they put themselves in high risk, low probability situations. Right? A lot of people put themselves in high risk, low probability situations. They come into the market, they do the exact same thing, and they wonder why the market just takes all their money from them. Because they waiting on you. Because they know a lot of people do this type of stuff. So if we're going to do high risk, we got to make sure that it is a high probability of success, even though the risk is very high, as opposed to a high risk with a low probability of success. Okay? So we got any other questions before I get up on out of here? Who the fuck that is? I know it take a minute because I got people like on a 3-minute hold. So if we don't have no last questions, going once, going twice, going 3 times. Oh, I know who that is. I don't have a specific way I pick companies, Miss Bella. I just do a lot of research. So, I do a lot of research. The thing about me is I'm a creative person, so I can have a manic personality at times. So it's similar to these videos. I decide to do something, I'm going to do it at a lot of intensity, and I'm going to do it really, really hard. So if I decide, okay, I'm going to be successful in this space, I just divert a lot of attention to that, and it almost becomes like manic. Because most creative people, they have a level of I don't know what you call it, but a lot of creative people have a manic personality in what they're doing. So I don't have a specific way I pick companies. I just do a lot of research, and what I do is I look for companies that are going to allow me to hit my goals based on what I'm trying to do. But what I try to avoid is companies that have not floats. They don't have volume over a certain they don't have volume over or under. I like my volume to be high enough to where the company actually moves while it trades, right? Moves while it trades. So Michelle Green, one of my power fives is Facebook, but I haven't traded that in a long time. But that's one of my power fives is Facebook, right? Because I understand Facebook's business model because I used to be a media buyer. So I understand 100% what Facebook does to make money. Like, I know because I'm paid Facebook a lot of money. So I know exactly how they make their money. They don't make their money with social media. They make their money selling ads. So Miss Bellamy, that's how I pick my companies. I just do a lot of research, right? So the question is, what is your goals on your trading plan? What are you trying to accomplish? And then what companies can help you accomplish that based on your budget? And you may paper trade stuff to get a feel of it to determine whether or not it's a good scenario for you. And you may only trade a company for 6 months, right? Another thing I do is I observe. I'm a real observant person. So I will look at a company for a very long time, right? So I may look at a company for 6 months before I even do anything. I'm looking at UPath. I think it's UiPath. It's hitting lockup in November. It's already selling off. There'll probably be nothing there by the time they get ready to go into lockup. But I just look at that company on a regular basis because what I find is that there's a lot of really good opportunity in this market, but the mainstream media doesn't even talk about it. So you got to be willing to do your research, right? Because there's a lot of opportunity in this market. There's companies that are running up every day. There's really strong companies that are they moving up like this, but the media don't talk about it. Miss Lady L, a lot of times it's based on market conditions, right? So what are the macroeconomic conditions? And then all those macroeconomic conditions, and this is in the VIP course. Is it sector? Is it industry? Is it market overall? Is it sector? Is it the industry? And how does that bleed into that particular individual company? And then based on that, you kind of determine how that's going to affect the company, right? A lot of things can move share price. You can get upgrades. You can get downgrades. Earnings reports. Let me see what else. That's some of the things. Guidance. The CEO comes out and says, you know what, we're doing real well this quarter. Or they come out and say, we're doing real bad this quarter. Those things can move the company. And then seasonality. Is that company seasonal? So most companies are seasonal. Right? Quiet is kept. Most companies have a seasonal pattern. They make more money certain times of the year. They make less money other times of the year. Now, individual micro events can change that, right? But that's how most companies trade. So when you start to that's why I really encourage people to trade a specific company. It's because you'll learn that seasonality. There's other ways to do it, but you'll learn that seasonality by watching it trade. And if you stick with that company long enough, you'll know, okay, this company normally this time of the year does this. Normally this time of the year, they normally do that. Then things may change based on the overall macroeconomic condition, which is why I just don't teach options by the numbers or the Greeks. Because if you don't understand the overall market, you won't understand options because they're a derivative of stocks. So you got to understand what's moving the stock. Okay, so Miss Bella May, we talked about in the course, what number of loss are you willing to exit? So what I want to encourage you to do is to maybe go back through the course again, because the question is, before you take the trade, you want to ask yourself, what's my profit and what's my loss? So every manager of capital does that analysis before they get into the scenario. Because your job as a capital manager, your number one job is to manage the risk associated with the capital. So the company is trading sideways, but you have theta left. Do you pull out away for expiration? The question is, have you lost on the play? If you have lost, what is your loss? Has it triggered where you're supposed to pull out of the play? If it hasn't triggered, well, then I guess, it's a coin toss. But if you have a loss number as a capital manager, right, somebody that is managing capital on behalf of their group, before you got into the play, what did you determine you was going to get out at? So Ashanti Cameron saying, how does a market maker changing my premium affect my sell-off of calls or puts? So when you say my sell-off of calls or puts, can you explain to me what that means? I don't understand your verbiage. And Miss Bellamy, if you understand what I mean, just give me a heads up. Because the reason why I answer questions the way I do, because the goal is to make it to where you understand how to operate, not to where you think there's a answer sheet somewhere. Don't exist. Right? I'm trying to make it to where you can operate in the market and you know based on the scenario what you need to do. I was talking to somebody the other day, really today, about our people and about how we're not taught to think a certain way. Right? So, you know, my goal is to help us think a different way that I believe is going to allow us to be successful. Because this game is bigger than the options market, and I've talked about this before. You can go buy a country's debt and dictate to that country how they need to operate. And we're not taught to think on that level. What we see going on down there with Haiti, I'm telling you, it got to do with money. That's not just something random. Got a lot to do with money. Right? It's a lot of different forces trying to get what they want to get financially in that particular area. It's real deep. And we're not taught to think on that level. Right? So we got to start asking ourselves, how do we make decisions with money? How do we see capital? How do we see the markets? Right? And see ourselves differently than just, you know, this one person that makes this individualized decision. Okay, I appreciate it, Miss Bellamy. So, yeah, so if you understand that question, before you go into every scenario, you got to ask yourself, what is your exit plan? So if it goes against you, how do you get out? And do you have the discipline to get out? Because one of the biggest challenges we have, myself included, is we don't want to admit that we're wrong. So when the play goes against us, because we don't want to admit that we're wrong, we sit in the play thinking it's going to turn around because I don't want to admit that I did something wrong. And if we can trade like a machine and just say, well, you know what? These are the conditions. Once it gets outside of those conditions, I got to cut or I got to sell at profit. Right? Because that's how computers think. They just create a function. It's based on conditions. Everything that gets out of those conditions, it acts. Right? So that's how they program computers. And it's going to be difficult because you're not a computer. You got emotions. You're a person. Exactly, Urban Homestead of money. Right? But there's forces in the world that don't have an issue making decisions based on money. And I'm not saying that everything with us should be about money. But that, you know, that's a money situation. It's always been, it's going to always be. Right? But everything in the Caribbean is based on money and keeping things a certain way. And we got to start seeing ourselves as playing the ball on that particular level. Right? Yeah, so that's the issue. So you're not going to be a robot, but if you can start thinking, it's discipline. It's just like, you know, I got to work out 3 times a week. Let me go work out. You know, I got to study so many hours a day for school. Even if I don't feel like it, let me go study. Because if you tell a machine to do something every 2 hours at a certain time and you program the machine, it's going to do it. Not saying that you're a machine and you should be one, but it's just thinking operationally like that. If you say I'm going to exit, even if you might be wrong, exit at that point. It's not about you being wrong. It's that you can't control the market. The market's going to do what it's going to do. Right? All you can do is ride the wave. So if you find that you know what, the wave ain't going the way I thought it was going to go, get out. It's better to get out with a minor loss, recapitalize. But a lot of times on the shorter contracts with the higher volatility, you get smashed so fast, it's hard to pull out and recapitalize because you got such a small margin of error, because you got such a short expiration date. And that's the downside of those particular contracts. And that's why in the course I asked you, well, why do people buy those contracts? It's because they're inexpensive. And because you get a quick turnaround. And I'm not telling people anything that I haven't done. I've played weeklies. I've made big money on weeklies. Right? But it was very specific situations. But for a lot of us, myself included, if you can buy more time, it'll put you in a position to be more successful. right? So last questions before we get up on out of here. Miss Bella, I started believing that the market had an infinite amount of money, and I stopped trying to make all the money I made on one play. So I 100% am convinced that the market has an infinite amount of money. You can never pull so much money out of the market to where it'll collapse. It won't work that way. They'll find some money the same way they did with COVID. They'll find money. And I stopped trying to make everything be on one play. So if I put $100 on a play and I get back 100%, I beat every bank in the world, right? So I may not be at the 2,000 a month mark, but because I really believe that the market is abundant, my plays are going to come. And another thing I know is that money comes in waves. So you can hit for $6,000 next month, you might hit for $1,500. But over the course of the year, it'll be $2,000, $2,000, $2,000. So when you stop thinking like a person that makes their money every 2 weeks or every week on the job, you know that money comes in cycles, money comes in seasons. And I know the market has an infinite amount of money. I can never pull all the money out of the market. And I know that I don't have to get everything on one play. So, you know, if you can pull 30, 40% out of your play, if you can be up 30% on the year, you beat pretty much most traders. Right? Just being up by 30% on the whole year. And the goal is to have your account be positive at the end of the year. Exactly, Urban Homesteader. And that's the real discipline. Trading is easy. It's managing your psychology that's difficult. Trading is not difficult. Once you learn this market and you spend enough time in it, you see plays coming a mile away. You see it setting up. You know what these people are going to do because they do the same thing over and over again. You see the patterns. It's managing yourself in the trade psychologically is what's important because you can be up and don't get out and lose 40% and you was up 350% because you're trying to get that little bit more because you're trying to make up, and I'm talking about you personally, I'm just saying in general, you may be trying to make up for a loss on a play earlier that week. So let me try to make it all back on this play. And that's what I'm saying is that really, if you ever study traders that work for people, it's in their computer where they got to exit at. They don't get to make that decision. Somebody else makes that decision for them. If they don't adhere to that, they get fired. So what we got to do as independent traders is we got to be a lot more diligent in managing our emotions because we don't have somebody over us telling us, well, if you don't do what we tell you to do, we're going to fire you. You see what I'm saying? So that's the challenge as independent traders. It's just like being in business for yourself. You got to wake up every day and go get it. Well, on the job, you just got to come to work and they're going to tell you what to do. So it's just, you got to be able to take that management of yourself psychologically. So you're 100% right. I've lost big money not getting out of trades. I got a video on here how I lost like $10,000 on Tesla. And it's only reason because I wouldn't exit and I was at profit because I was trying to get that little bit more. If I would have took what was on the table, I would have been up. But trying to get that little bit more out of it is how I killed plays. And you don't have to because there's so much money in the market. It's not like it's not going to be some money next week. You know what I'm saying? It's going to be money next week. It's going to be money the week after that. It's going to be money the week after that. In fact, next year, the market's going to be bigger than it is this year. It ain't going nowhere. They only going to continue to expand the size of the market because this is their thing. They built it. And it represents what they've worked for this long. So it's not going anywhere. Yeah, Michelle Green, I'd have been fired too. Yeah, if I'd have been fired too, if I'd have worked for a trading desk because I've messed up good trades by not exiting. Right? And that's their money, so they definitely would have fired me. Right? So appreciate the live stream. I'm finna get up on out of here. It's been about an hour. I want to tell everybody to look into the highest paid part-time job of the Word Options training course. It's a self-paced study course. It's video modules. My goal is to get you to $2K a month. Right? It's not hard. It's easy. Right? This market is not as difficult. We've dealt with things in life that are way harder than this market. The biggest issue is managing your emotions and what do you actually desire, right? So if you actually desire a result and the market can help you get it and you're willing to work for it, you can get it. Regardless of how much work you got to do, how long it takes, you're going to make that your desire, right? I can help you because what I'm not going to do is just sell you the course and then just say, have at it. I'm going to try to help you get there. I'm going to work with you because it's my desire to help people in this particular area because I'm very passionate about it. Because one thing I want to see is our people be a lot better financially, be a lot better business-wise. It's something I'm very passionate about. So the link should be in the description. We got the core course. We got the VIP course. Moving everything to another platform. Now, I know that's been a long time, but we're getting it there slowly but surely. If we got any questions, hit me up. But I want to tell you, if you got into the course on the discount, well, you got what you asked for. So now I'm looking at you to get up to the standard. Everybody else that's been in the course, has been applying yourself, I want to tell you to just stay consistent and you'll get there. Right? I know way more about the market. I understand way more about the market than I understood a year ago. I was even looking at taking the Series 7 test just to take it because I know I can pass it. The issue is that I got to be sponsored by a particular brokerage firm, so I got to work for them to get sponsored to go take the test. I can't just take the test by paying for it. So as you stay in the market longer and longer, you'll learn more and more and you'll pick up more and more. So if you're in the market, stay consistent because right now, just on this live stream, we've had a more in-depth conversation about the market than probably 99% of the people inside the United States. So you come off here, you know more about how the market works than 99% of the people inside the United States. They have no idea what's going on in these markets, right? If you got into the course, I would tell you to stay consistent. If you got into the course on the 4th of July discount, you don't have an excuse as to why you can't be successful because you got in at a decreased price, so the price was not an obstacle for you. So now all you got to do is work to get to success. So I want to encourage you to get rid of any obstacles or any limiting beliefs about your success level and apply yourself and at least give this particular this space a chance to find out whether or not it can help you get what you want. And if it can't, well, then you can go to something else, but at least you applied yourself over a length of time to try to find out. Because I didn't know anything about the markets a few years ago. If I would have known this, I'd have been doing this 20 years ago as a kid as opposed to doing it right now. But everything happened for a reason. So this is David W. Williams, also known as Diamond Dave. Talk to you later. Glad you came through.